If someone tells you that property investment is as passive as stocks and shares, then they're probably lying to you. When you buy a share in Apple or a Vanguard index fund, you're not going to get a call if something goes wrong with that company. Property is a physical, tangible asset. That means that if something breaks within that property, the chances are you may have to take a call at some point to get something replaced or pay for something that needs to be fixed. But here's a secret that experienced property investors and high net worth individuals understand about property. Although it isn't passive by nature, it can be autonomous by design if you set things up in the right way and you target the right properties for this. Today, I'm going to show you what you need to be aware of if you want to invest in property and continue to be as hands-off as possible. And I'll show you how we help our clients build their portfolios in the background so they don't take over their whole lives. In the next 10 minutes or so, we're going to cover the following 3 topics. 1, why investors continue to invest in property, even though it's not as hands-off as things like buying stocks and shares. 2, what you need to be aware of, and more importantly, what you need to avoid if you want to be a hands-off property investor. And 3, we'll look at 3 non-negotiables of what you need if you want to be a hands-off property investor. If you're new here, welcome. My name's James. I'm the co-founder and managing director of a property investment consultancy called Freighter Property Partners. I've personally helped hundreds of investors purchase tens of millions of pounds worth of property and help them scale portfolios in a way that doesn't give them a second job. If you like the content, don't forget to hit the like button and make sure you subscribe for all things property investment. But let's get into it. So if it's not as easy as just clicking buy on a trading app, why are the wealthy so heavily invested in property throughout the UK and globally? It really comes down to 2 things. The first is control and the second is leverage. First, let's look at the hierarchy of passivity. Essentially, how passive is a property investment and what does that look like? Level 1 is paper assets. You're looking at things like bonds, stocks and shares and ISAs, which are 100% passive. The problem is you're at the mercy of the market. The next stage is hands-off property investment, things like buy-to-lets, where you're not going to have to deal with day-to-day problems with the tenants. This requires an initial system to get off the ground, but once you've got that system set up and you know how it all works, you can take a step back and make sure that you're investing in the background and not giving yourself a second job. And like I mentioned, the reason people choose to invest in property is leverage. You can't just go to a bank and ask them to 4 times your returns by giving you leverage when you're investing in things like stocks and shares. And even the most advanced investors and traders don't use leverage because of the risk involved with leveraging things like stocks and shares and the overall market. In property, however, you can do this by using mortgages, and you can use 50k to purchase a property worth 200, so you maximize your returns long term. Let's look at the numbers. 5% growth invested in the stock market gives you £2,500 as a return of your 50k invested. That same 5% growth in the property market, however, gives you £10,000 because you're getting equity based on the value of the property, the 200k, rather than the 50k deposit that you've put in. This is before you start calculating things like your rental profit that might be 5 or 6% return on the total cash you put in as well. And that's really where property can really outperform other investment classes. Yes, obviously we've not looked at things like stamp duty and legal costs and things like that. So realistically, you're looking more like 70k to buy a 200k property. But even if you look at 70k returns in the stock market, property still blows it out the water. I accept that property will never be as hands-off as things like stocks and shares or ISAs because they're real assets. But if you set up in the right way, you can give yourself the opportunity to still invest in property, have it not take over your whole life, maybe manage it with 1 hour per month and still build your wealth and get 4 times the returns that you might get elsewhere. This is really where property gives you the opportunity to build your wealth in the long term. If you start to extrapolate those numbers for 5, 10, 15 years down the line, you start to really get yourself in a position where your wealth is growing, you're refinancing, you're scaling a portfolio, and you're really building your wealth in the long term. Having said that, here's where most people get it wrong within property. Most investors, when they're starting out, target the best possible return on their cash in terms of best possible yield. This means that they target the wrong types of properties and end up giving themselves a second job. If your goal is passive wealth through property, there's 3 things you need to avoid. The first is HMOs. HMOs are a great strategy for an investor that doesn't mind being a little bit more hands-on with their property investment or as part of a diversified property portfolio. They're better yields, but they're definitely more hands-on because you have more tenants, more tenant turnover, more maintenance, and so on. So if you want to be a passive investor, HMOs might not be the way to go for you. The second is out of area, flips, and project-based property investment. Unless you've got a power team on the ground already and you've already got this network of people that can come in, do the work, and make sure that everything runs smoothly, this isn't going to build your wealth in a way that is passive. You're going to be really hands-on, either project managing the site or making sure that things run smoothly. And it's essentially, again, giving you a second job when investing in property. When you marry this up with the fact that you're investing outside of your area, you could be investing in a property that's 100 miles away. This is going to mean that you're going to have to travel more, it's going to give you lots of stress and cause you more and more headaches. The third is just targeting the cheap properties or the cheap areas. The lowest value properties often look attractive because they have really strong yields, like 10% for a normal buy-to-let. However, these properties are often that cheap because they've had a lack of growth, and they often have lots of headaches that come along with them because they're older properties and not really looked after. This causes you as an investor to have more management and have to be in contact with your management agent more and more, which again is going to take up your time and energy. You're better off investing in quality assets in areas primed for long-term growth and rented out to professionals or families that won't mess around. You need these tenants to be reference checked thoroughly and make sure that they're going to pay on time and give you minimal headaches. Basically, if you want a quiet life, you need a quality asset. Really, to stay passive, you need to stop thinking like a landlord and start thinking like you're a shareholder within a business. Here's the 3-step blueprint we use to bridge that gap. The first, institutional asset. We focus on high-spec quality assets in areas primed for long-term growth. We want good quality assets direct from developer that come with build warranties, so our asset is protected at least for 10 years. Properties built in the modern day, built to modern day standards, have 60% less management and maintenance headaches than older Victorian properties. So better quality equals fewer headaches. The second is management. You don't just want to appoint any old management company who will manage your property. You need to make sure that you're working with a vetted specialist who will look after the property and the tenant as best they can. You need to ensure that they're completing semi-regular checks on the property to make sure everything's being looked after. And once you've got that, you need to make sure that their communication is really strong with both you and the tenant. Their job isn't just to collect rent. Their job is to protect your return on investment and handle the operational stuff behind the scenes before it even gets to your desk. And 3 is your tech stack. In the modern day, technology is your friend, especially as a landlord that doesn't want property to take over their whole life. Make sure that you're set up in the right way, whether that's management, research, or anything in between, and this can save you time, energy, and effort in the long term. Your input as a hands-off property investor should be limited to around 1 hour a month, whether you have 3 properties or 20. If you're doing more than this, and significantly more than this, then you've got something wrong alongside this process and you need to fix that so you can be more hands-off. If you are looking to scale your property portfolio at the moment and you don't want this to take over your whole life, then we help our clients purchase properties across the best regions in the country. I'll put a link in the description so you can follow and fill out a form to have a free chat with one of the team. And if you're not looking at the moment, not to worry. To conclude, property is an active business, but we can turn that into a passive income stream for you. But I hope you found the video useful. Feel free to comment any questions you have, and I'll see you soon.